What's up, world? Jake Blickenstaff here. I'm a commercial real estate broker. I live in Athens, Georgia, basically northeast Georgia, and I cover really the entire state of Georgia when it comes to commercial real estate. So in this video, I want to break down what the primary differences are between cap rate and ROI, because I hear them used interchangeably, not only by clients, but also by other brokers that maybe just think they mean the same thing, but they really don't. So this is going to be a really quick video that just explains the differences between the two and how to actually calculate them as well. This is going to be really huge, not only if you're a broker, but if you're an investor. If you're looking to get into real estate investing, it's important to know what these are and how to actually calculate them. So with cap rate, it's going to measure the property's income performance without any financing involved. So if you're going to buy something outright cash. And ROI measures overall investment performance, and it is going to factor in financing as well. To find out cap rate, that's going to take your NOI divided by your purchase price. And your NOI is your net operating income. So after all expenses, operating expenses, taxes, insurance, everything else comes out of the income that you receive. And then ROI is calculated by profit divided by the cash invested to get into the deal. Now, a real world example of this, let's say that there was a purchase price for a property of $1 million and it requires a 20% down payment. So that'd be $200,000. So your loan amount would be 80% of that value, which is $800,000. And let's just say for this example, we're going to calculate that at a 6% interest rate. So your gross rental income, your GRI that you would receive on this property, let's say it's $120,000 a year. Your operating expenses that you have every year just to operate and own this property are $40,000 a year. And the loan payments that you have, or your debt service, is $51,000 a year. So taking those into consideration for this example, let's calculate the cap rate. So you take your NOI, because that's going to equal your gross rental income minus expenses. So $120,000 minus $40,000 from the previous example that we gave gives you $80,000. And to get your cap rate, that's going to be your NOI divided by the purchase price. So that's $80,000 divided by $1 million, because that's your net operating income versus how much the purchase price of the property was. So that's 8%. Now, to calculate the ROI on this, it's going to get a little bit more tricky. So you take your cash flow after debt service, so after you make your mortgage payment, and that's going to include your NOI minus your loan payments. So for this example, it was $80,000 minus $51,000, which gives you $29,000 left. Now, the ROI formula for this is going to be annual cash flow divided by cash invested. So that's $29,000 divided by $200,000. So that gives you a 14.5% ROI on this deal. So this is important because if you just look at deals that are out there, you'll see them advertised at a certain cap rate. And a lot of unsavvy investors and sometimes unsavvy brokers, like I said, will think that the cap rate equals the return that you get on a deal, which is not accurate. So for this example, remember our cap rate originally was 8%. And so that is going to evaluate the property's income potential, and that also assumes a cash purchase. And the ROI on the deal was 14.5%. So that's going to consider leverage, and it shows actual investor returns that you're going to get after everything's said and done. The cool part about ROI is financing a property actually increases your ROI because you have less money out of your pocket, and it makes investments really more efficient. But both metrics are going to be useful, but they serve different purposes. Hopefully that helps clear things up. If you guys have any real estate needs or questions, happy to reach out. Talk to you later.